So, hello, and I welcome you to the Trading Spotlight webinar today on Friday, the 23rd of August, 2019. My name is Jens Klatt. I'll be the moderator here for the upcoming something like 45 minutes. And yeah, I want to welcome everyone joining us today. And we want to pick up the topic we've ended last week here with the DAX 30, and today I want to focus on the SP500. Before I start, the question, can everyone hear me? Can everyone see the screen right now? How to profitably day trade the SP500? All in all, it seems good, but yes, perfect. Perfect. Everyone can see the screen. Everyone can hear me. That's beautiful. Yeah, then we want to jump straight into the action. Give a little overview of our agenda, what we want to have a look at today. So we want to define the open range breakup setup for the SP500 CFD once again. So we want to go through how to define a range, for example. We want to have a look here how this range concept can be applied to the SP500. Some of you probably recall. If not, please feel free to check out the recording of last week's webinar. Some probably remember that we defined the open range here in the DAX between 8 to 905, and we looked at a 5-minute chart. I can already say that this is different today. We'll look at a 50-minute chart here. In the S&P, we have another aggregation for the exponential moving average we want to use to identify our advantage. And also, we are looking at a strategy, a day trade strategy, which means we are intraday positioned. And not only that, but we have a different time span we look at, because the market opening in the US is, yeah, I think everyone can already see that it's a different opening. Because of the 6-hour delay, let's call it here. When Wall Street opens in German time, it's 3:30. London, it's 2:30, 1 hour difference. Nevertheless, the overall concept is in fact the same. Still, we want to look at how the setup looks in the real world. We don't only want to look at a chart I snapshotted and presented, or an article. You can also read through the 3 steps we have to go through in the Admiral Markets traders blog on the website. I give you the link in a few seconds. But also, we want to show this for an example from yesterday. I found out that yesterday the trade would have generated a small profit. It's not big profit, but I would have presented this also if the trade would have been stopped out, for example. So I try to really make it as real world connected as possible to give you an idea of how it really looks like. And the great thing about this is, even though today is a little special, because we have Jackson Hole today with a speech from Jay Powell. It's highly anticipated. That I could really imagine it to be a high volatile event. Still, you can also download the demo on the website from Admiral Markets, for example, right now, and then apply this concept here to the market opening at the US market opening. So you have still something like 2 hours to go for today to just see how it works and get a feeling for that. Then, and sure, I want to show you that this is a real profitable strategy. In fact, last week, it was a little difficult, because when we looked at the backtest result here from the DAX, for example, I presented, it was that the time span was only slightly above 1 year, even though it's a 5-minute time frame we're looking at, and it's an intraday strategy, so we generated over 200 trades. Still, 1 year is, yeah, sometimes such a strategy also works fine over a time span from 1 year. You can trust me that it's also profitable here. In the past has been profitable. This will be completely different today. So today we'll look at a backtest result which covers a time span from 2010 to 2017. I also want to give you an explanation why only 2017. It's not that it completely switched from there, but it has to do with a small story behind that. And I will present to you then a backtest result here covering a time span of 7 years for a 50-minute trading strategy. We look at over 1,000 trades, and you can see a quite impressive equity curve with no pyramiding taking place here. So meaning that if you, for example, I don't know, you started out with a 10,000 euro account and then you traded the account up to 15,000. And if you say you're risking 1% per trade, you start out with 100 euro per risk per trade, 1% of 10,000, then you increase this steadily based on the equity you have. And for something like 15,000, then you can risk 150, for example. But no, you traded this steadily, and it's still a very, very impressive equity curve, very smooth. I still want to give you an idea of how to smoothen the equity curve further. So it's just a basic strategy we look at here in the backtest result, and I give you, or let's say I re-emphasize the ideas for discretionary touch. And then, sure, we want to answer the question how to profit from the new knowledge in your trading, how you can adapt this in the real world, and not only that, but probably also how you can improve your trading by that. So that's it on the agenda. This is me. So before I now go through every every step, I probably here give once again the link to the interview we did here, and I write this here in the chat box. 1 second, interview. So this is the interview link to my story. So it's probably yeah, it's compared to only looking here at each step in my career, it's probably a little more interesting to read how I got into trading, and my especially failures are probably interesting, and you will see that it's not very different from many other stories here. People who started trading, who gave it a try and failed. It's common. It has been the same for me. It's not that, for example, Market Wizards, the book series here with interviews, I'm usually referring to this quite often. And there's a story from Tom Baldwin, one of the biggest T-bond traders of all time, and he got started with trading something around his 20s or something, with his wife being pregnant, only having $25,000 to his name back in the 70s, 80s, I don't know. And then he had to make ends meet, and he was successful. So billionaire today, everything cool, but this is not the usual way, let's say. So usually you have to fail first, and then you start started from there. And as you will read in the interview, the same is true for me. I'm here today for Admiral Markets as a speaker. One thing which is noteworthy here when it comes to Admiral Markets is that it's a Forex and CFD broker with over 8,000 financial instruments and offices in over 20 countries around the globe. So this is, in fact, here a global webinar in English, and it's not just that Admiral has an office, for example, in London, but also one in Australia, for example. Just to give one example, there's also an office in Chile, for example. There's also an office here in Germany. Here in Germany means I'm located in Germany. I'm located in the capital of Germany, in Berlin, and we also have an office from Admiral Markets here, which is really nice, to be honest. So just to give you an idea that you're really talking or listening to input here from a broker, which is considered a global player in this industry. And you please feel free to join the website and then find out more about Admiral Markets in general. And that's it around the introduction. Let's then jump straight into the action and have an idea here on what we want to talk about. We have to define the open range. Therefore, as usual, again, we have to define a range first. So a trading range occurs when a security trades between a high, low within a certain period of time. That's the usual explanation what a range is in fact. So when looking at the open range in this case, you look at the specified range here. We define the open range as a range of high and low that a market makes during the predefined time period of daily trading activity around the market opening. So when it comes to the SP 500 then, we look at the market opening, and here at the first 45 minutes of trading. So when Wall Street opens, this is usually around 3:30 p.m. Central European time, so German time, or 2:30 London. Then you wait for the first 45 minutes here, the market to make a high and a low, and then the idea behind an open range breakout in this case is you say, if we break out in direction of a pre-identified advantage here, we expect the market to trend here in direction of this breakout over the day. In fact, that's something which wasn't invented from me or something, or from someone else, but was something which was discovered already in the 1980s. And I think Toby Crable is also a very successful hedge fund manager. Toby Crable also wrote a book on this, while the book itself, I think, is the summary of several articles he wrote for a day trading magazine. I'm not really sure if this is 100% correct, but I don't even remember the name. It was a quite long name. I think it's Short-Term Day Trading Patterns or something for day traders. I don't know. I will find out and provide the link here within the description of this YouTube video. So by the way, if you're watching the recording here, please feel free, if you like what you're watching here, to give us a thumb up or something like that, or comment, ask your questions. We'd really appreciate to answer these questions then here. And yeah, so it was invented, or not invented, but it was discovered from Toby Crable in different markets, and it's still working. Even though the hit rate is only around 45 to 50%, still the payoff is very interesting. From a mental perspective, it's difficult to trade it because of many failures sometimes, or fake breakouts, for example. But still, there are ways to make sure that you increase the probability of a breakout of being a real breakout instead of a fake breakout. So to reduce these potential fake breakouts, one can work with filters. So for example, this is only one example. There's also another one with the exponential moving average to identify the overall advantage. We look at here, especially that then. But there's also a chance, as I already presented last week here around the DAX, we have a chance to say we want to see a minimum width of the range then, for example, in case of the DAX, but you can also apply this to the S&P open range breakout here. Yeah, want to see a minimum range width of 0.2% of the asset price you plan to trade. So if we look at the S&P 500 and we assume that the index is trading at 3,000 points, 0.2 means the range width has to be minimum 6 points or wider than that. And the reason why we do that is very simple, in fact, because we want to avoid to be positioned in a breakout trade here within periods of low volatility. Usually, if the range width is below 0.2%, this is usually a sign that volatility is really low in the market right now. So something like a holiday season, for example, or yeah, mainly holiday season. And usually, if a breakout occurs during these times, it's usually that the market is like it's only coincidentally. It's not really a real deal breakout occurring, driven by, for example, a comment from a central banker, something like that, or a real fundamental driver where you have a high likelihood that the market will strongly trend in direction of the breakout. It's more like a coincidence, and the market fakes out then and drives or trades back into the range. Or if it breaks out, then it's like consolidating, probably slightly drifting, but it's not really like a strong breakout and then move in direction of the breakout and pre-identified advantage. So this is one of the reasons you're using such a minimum width and to avoid such periods of low volatility. And also, there's another thing which is highly important for us and our upcoming definition here of the open range for the S&P. We will only trade the breakout in direction of the overall advantage, which is shown by a moving average, for example. It's a very simple approach. What's great, by the way, you will see that it's 4 steps or 3 steps. The fourth one is to to tell where to exit the trade if the market does not hit your target, respectively. Here, it's a time stop out, in fact. But this is something we'll discuss, or I'll present to you in this in a few minutes then. But you will also see that there's a good way to program this approach to make it fully automated here. For example, with an expert advisor, you can run it then and see a system or an algorithm then generating the trading signal, placing the stop and the take profit level, and then running it over and over and over again every day without having the need here to sit in front of the screen every day. So now the question is how to use the open range breakout for the SP 500 CFD. And there we have to go through the following steps. So first of all, we define the open range between 3:30 to 4:15 p.m. Here it's Central European time. Right now we have summertime, so it's CEST. It's Central European summertime. But the difference between London and Berlin is usually 1 hour, let's say. So we define the range then between 3:30 to 4:15. And then we have a high and a low defined. And then we say, no, we have to find out. That's not we say, but first of all, we have to identify the overall advantage based on the 15-minute EMA 10. Remember, when we looked at the DAX last week, we had an EMA 50 on a 5-minute time frame. Here we're looking at a 15-minute EMA 10. Some of you probably recall that I also said you can adapt the strategy I presented last week for the DAX to other markets. And this is usually what obviously what we do here. So it's not that you say every market is a 50-minute chart and then it's in EMA 10, but you have to adapt it accordingly. DAX 5-minute, EMA 50, S&P, for example, 50-minute EMA 10. Some of you probably now ask or wonder, okay, and what's it for the Dow Jones? I haven't checked it, but and this is probably an idea you can then find out yourself. Try several aggregations here. What's very important in this regard is that you make sure, if you have found a solid fundament for your open range strategy here, that you make sure that here, for this example, for example, let's take this 15-minute EMA 10, that you tried also on a 15-minute EMA 8 and 15-minute EMA 12. If the result is highly different and the 15-minute EMA 8, for example, is generating catastrophic results here, and it's highly negative, and you're losing money with the approach. And the same is true for the EMA 12. Then it's probably only a coincidence that you got lucky here with the EMA 10. So usually, if it works with EMA 10, then it should also work with EMA 8 and with the EMA 12, for example. In this case, it does. And also, we can see that in the backtest that we are looking at a very long time span here. For 7 years in a backtest, but still this is something to remind. So you have to be profitable also in the neighborhood, and then it's the question of which EMA generates the smoothest equity curve, which means not only the best result, but also which has the lowest potential drawdown here. Then you take it from there. So the next step is then that you easily say, if we trade above the EMA 15, EMA 10 on a 50-minute chart, we only trade in direction of the long side here. So we only take trades on the breakouts on the upside, while if we trade below, we only take trades on the downside of the range, and that's in fact it. And then, which is really interesting here, is not the stop. This is self-explaining, because we say if we have a high and low defined, then we say in case of a long trade, we take the lower end of the range where we place our stop. While if you take a short trade, then we have the higher range of the higher end of the range, and we take the stop level here while we trade in direction of the breakout. What's now very interesting is where do we place our take profit level? And the interesting thing is we don't have it. Or let's say we have one, but it's not the common way that we say it's price XYZ, but it's a trade which is taken out here at 9:50 p.m. CET, so 10 minutes before Wall Street closes then, in fact, and there's no take profit set, which means we work with a, let's call it time take profit. This is a very interesting approach, but what we could find out was, what we found out, let's say, is that if we work, for example, with the predefined take profit level, as we did last week with the DAX, we work with a risk reward of 1 to 2. Well, let's assume the risk is 30 points, then we place our take profit level 60 points away from our entry point, and then we have our risk reward given by 1 to 2. But in this case, we found out that it makes no real difference. In fact, we get the best result if we take out the trade manually here at 950, then with this time take profit, in fact, which is really interesting because in times of strong trends, you probably have seen that several times when breakout occurs or breakout occurred here over the last months in times of higher volatility. There was a very strong trend happening in the US markets. Has been on the downside, but also on the upside several times. Most of the time, given by some comments from President Trump, for example, who tweeted whatever escalation in the trade war, and then the market just shut down. And the interesting thing was, it started trending strongly in direction, and on the downside, it took on really momentum, and it wasn't really reversed the momentum, but the market really closed here in the region of the lows. There has been times, sure, there has been times when there was some kind of reversal into the closed end, and some of you probably have heard about the stories. Something like plunge protection is now stepping in, trying to stabilize the markets. It's just rumors still. I mean, I think it was shortly before Christmas last year, when U.S. Treasury Secretary, I don't know, Mnuchin talked about the plunge protection, then we became aware that there's definitely some kind of manipulation probably taking place. But however you put it, and this is not part of this webinar, the thing is that you will find out in the long run, it really makes sense to keep the position open till that time here, and you get a very, very smooth equity curve by that. So then the question, how does the setup look in the real world? As also last week, I want to show you here, first of all, a chart I prepared. So this is an example. As you can see here, on the x-axis, it's February, but I will show it to you here also from yesterday, but also in an article in the chat box. By the way, let me just do it. No, before we do that, first of all, let's have a look here in the real world, the setup, how it works. So this is the open range, which is defined here by the high and the low between 3:30 till 4:15 p.m. Central European time. So this is the high, this is the low. As you can see here, we trade above this purple line. The purple line is, in fact, this EMA 10. And if we trade above that, here within this time span, then we say we only enter long trades. So we have then here a buy stop order in this region, and this is where our entry occurs with the breakout higher. And here is the exit point of the trade. It's not a preset take profit level, but we take out the trade at, as I already said, 9:50 p.m. Central European time, in fact. So this is the example here, and we'll go back to the slides then and the backtest result in a few seconds. But now I've prepared already here the article for July that was or is an example. And if you go through the traders block section, by the way, on admiralmarkets.com, you can find it here via analytics, and there's the traders block. You will see plenty of these setups in the past. So it's not only one, but there have been plenty of articles which we prepared here and uploaded. And the latest article here in this regard is the July 24th. Next week on Wednesday, we'll also have, I think again, around here, 11 a.m. By the way, I don't really know if it's London time or if this is a European time, so European, German time in this case here, Central European time, but it really doesn't matter. Around noon, let's say, you will see another example of such an article occurring here in the traders block section. And now I'll give you here, let me just do it shorter. Let's call it ORB SP500. That's probably the better way to put it. I don't really need the whole headline here. And then just click here on the link in the chat box. So this is an example which was from where we have it. 1 second. Let me just see. 3rd of July. So 3rd of July. And now let's probably have a look here at, oh, this is nice. I like that. Why do I like that? Because I have a short position in the market. Yeah, but this is not topic of the of the webinar right now. But I really do. I really like this push here on the downside. Whatever reason, I'm not sure. Probably someone leaked comments from Jay Powell here at his speech at Jackson Hole. I really don't know. Well, however, we want, first of all, we want to look here at the example from yesterday. So here you can see again the purple line, and you can also see here those horizontal lines, which are defining the open range between the high and the low between 3:30 till 4:15 p.m. And now the thing is, it's really interesting to know that. So you can see here that the closing price of the last 15-minute candle is what is important. So why do I say that? I say that because sometimes you wonder, what do I do if we do not break out of the range and the market then trades back above, for example, here this purple line above the EMA 15? What do I do then? You switch. So let's assume that here this was the closing price, which is not, because the range here was defined with the low of this last candle, in fact. So, but let's assume it was already defined and we closed here above. So then you have a buy stop in the market and you're only trading breakouts on the upside. Since you say, I identified the advantage on the upside, which means I'm trading then only breakouts on the upside. On the other hand, if we then trade below this EMA 15 and close below but do not break out of the range, you switch from a buy stop to a sell stop order. While it still is the same procedure, you say then, okay, a buy stop has a stop then below the low of the range, and if you switch the order and have a sell stop in the market, then you switch the stop to the high of this range. And here in this example, for example, you can see that it's here the range, and with the next candle we broke out on the downside since we closed with this 50-minute candle below this EMA 15, and then we took it from here. So in fact, we were short for the day, and we closed the position here at, let me just see, with this candle. So this was the closing price. As you can see, it was a small profit. Somewhere within here, we closed the trade. So with a small profit of something like, let's say, 2,925 and 928, yeah, something like 4 or 5 points or something. That was the result from yesterday. But all in all, as you can see, this is a setup which will also apply today the same way. So first of all, we have to wait for the first 45 minutes. So in fact, you now look at the price action, you're probably really excited and think, okay, I have to jump into the action. This is the great thing about having a clear, predefined plan in your trading. And it's discipline and it's patience, which is one of the traits of successful traders, which will, by the way, be a topic in one of the Trading Spotlight series then next month. It's something I prepared already yesterday, just to give you some information. There's already a plan for then the upcoming topics here in this Trading Spotlight series. And so what's really interesting is one of the key traits of successful traders is discipline and patience. So therefore, nevertheless, you need a predefined entry scenario, respectively a plan you follow, a strategy which you follow. That said, if our plan is here, let's switch back to the slide. One sec here. So if our plan is to define the open range between 3:30 to 4:15, that's exactly what we do. We wait for the first 45 minutes. We wait for 3:30 to happen. Then we look, where's the high, where's the low. For the next 45 minutes, we define our range. We have our horizontal line on the upside, on the downside, and then we take it from there, and we wait for the breakout to occur in direction of the identified advantage. So this is really cool because it then means nothing more than, let's now again switch back here. That means we don't really care about what's happening right here. Even though it's interesting, sure, and I'm right now already excited to see why this happened here. Even though I could somehow probably, it's not Powell, probably it's some headline around China. There was some rumors now going on that China has to bring up countermeasures. That was something which was communicated from a Chinese journalist shortly before we started this webinar here. But whatever it was, we don't really care. We don't care. The setup doesn't care. We have to wait 3:30, 4:15, then we have the high, the low, and then we take it from there. Even though so far it looks as if it will be a short trade if we keep on trading below the EMA 15. So there's where the advantage is then. And then we take it from there. Okay, let's come back to the slide then. And now let's have a look here, not only at how it looks in the real world, but have a look here at the backtest results for 7 years. And let me just also give you an idea why it's only July 2017. But in fact, I will present you now why it is the case. Even though, first of all, we start with this quite impressive equity curve. It's the basic strategy. The strategy I just presented to you created this result here over a time span from November 2010 till July 2017. You can see it's not the classic backtest result in the MT4, MT5, but this is by Axel, done by Axel here. And you can also see here the EMA 10. This is the aggregation. The great thing about this is you can play around here with the EMAs, and I could also present you some other examples. But now the thing is, what I want to tell you is the story behind this. So I ran a webinar together with a very quantitative-oriented trader, and it was also on the SP 500, but also on other strategies. And we did this webinar. And so before we had the webinar, he said, just please give me the input parameters for your strategy. I'd really like to run a backtest and show it then to the audience here. And I don't really want to switch between MT4, MT5 and irritate the people then with an Excel backtest here. But I only want to give this the way I do it with Excel backtest, and was no big problem for me. So I gave him the input parameters. Now the day approached, and we had the webinar together, and then he had some troubles with his internet connection for whatever reason. And I just anticipated that probably right when he was start to talk about the strategy and the backtest result here, there would be some interruption in the internet connection. So I took a screenshot, and this is one of the reasons why it looks so, weird, let's say. I took a screenshot, and right there, after taking the screenshot, 2-3 seconds later, the internet connection interrupted. Since I knew which parameters were in there because it's my strategy, I was capable of running the webinar then. And I usually, when I present these ideas here around the strategy, I usually take the screenshot and present it here. Also to give you the small anecdote, but also because I think it consists of all necessary informations, and this is the reason why we ended here at July 2017. But let's come back here to the result itself. I think it's quite impressive. Sometimes you have to probably look a little deeper here, but you can see the most important aspects here within these three columns, respectively, these three lines. You have the win rate of 47%, you have the average profit, and you have the average loss in R. So one risk in this case. And let me just, even though you can already see it here, it's no big it's no big surprise that the expectancy of the strategy is obviously profitable or positive. So we already have a positive expected value. Now I opened editor. Oh, I'm sorry, that wasn't good. 1 second, please. So I just want to share with you a formula. It's very. I just hope that everyone can see what I'm right now tipping here. The average expected value is given by the average gain of a strategy multiplied with the hit rate, and then you subtract the average loss multiplied with the loss rate. So let me just do it that way. And that means that I shorten things up here. I make it EV, okay, for expected value. And then we can give in those parameters here. The average gain, which is 108 in this card, or we make it with 1. So average loss, I norm it to 1, which means I have to divide 108 by 0.82, and then you get 1.31. Okay, so let me probably do it that way, then, so that you really know what I'm doing here. So I do the following calculation: 108, and I divide it by 82, and then you get 1.3121. And these are the numbers I'm working here with. So this is where I get 1.31 from. So then I multiply it with the hit rate, which is here 47%. So 47%. And then I subtract 1 multiplied, and you can see why I did this, because it's easier to calculate, because now I have only to say I subtract 0.53. So, and then you get 6.1, you subtract. I did this calculation several times, so it's not that I'm some kind of a Rain Man or something, but I did this calculation over and over again, so I know the result, which is giving us 0.08. This is not only bigger zero, but it's also, oh, by the way, sorry. So it's not only bigger zero, but you have to interpret this number here. What does this mean? It means that on average, per every euro we risk, or US dollar, JPY, whatever currency you're preferring, for every euro in my case I risk, I can expect to make 0.08 cent per trade. So it's not that I risk €1 and I get 8 cents out of it. No, it's for every euro I risk, I get 8 cents back. And so that means, on the other hand, for example, I risk, let's say, 100 euros. I can expect on every trade I make, even though it's it doesn't really matter if it's a winner or a losing trade, I make 8 euros per trade in case of risking 100 euros. That means, on the other hand, if I, let's say, make 200 trades a year, that means that I'm then making 8 euros per trade multiplied with 200. Then I have 1,600, and I have an average, an expectation of 16% on a 10,000 euro account, for example. That's what I do here, even though it's purely theoretical, but nevertheless to get an idea of what we just did here. And yeah, as you already can see, it's a quite impressive result. Number of trades we look at here is 1,347, and all this you were capable of doing that. With a very simple strategy, but just following those 3-4 steps I just presented in the slide before. So now the thing is, you probably wonder if we have a chance to make it better. Even though I give you an idea right now, still I want to focus on something different. Before I start to look at this, let's have a look again at how we can smooth the equity curve. So ideas for a discretionary touch here. First of all, the question is, how can you find an advantage here? So therefore, when we look at a 50-minute time frame, our dominating time frame is, for example, an hourly chart. So this is something you can see here. And then we say, look at where we trade. Do we trade in an accumulation or distribution area? And then we decide whether we trade aggressively in direction of the trend, or when we trade, it depends on whether we plan to skip the trade probably, or we trade it then with a, let's say, with a smaller position size here, conservatively. Which means usually if I say I risk 1%, in case of trading within the distribution area, then I say, okay, I now trade only 0.5%, for example. I only want to show you now the theory behind this. Probably one day we will probably, within this Trading Spotlight series, do a webinar on this. I think it's a quite interesting topic, in fact, but really here I today want to focus on something different, to make sure that you somehow probably see how you really can use the strategy and make the most out of it, especially in combination with the already known concepts we presented 2 weeks ago in our trading psychology webinar. So look at the recordings here in the Trading Spotlight series, in the YouTube channel from Admiral Markets, and you probably see there's also a recording of trading psychology, and there was talking about conscious competence and all this, and unconscious competence especially. And the great thing about this strategy is it's very easy duplicable, and this makes it possible to run it over and over again, get used to it, and thanks to that, thanks to repeating it over and over again, make it part of you, part of your trading routine, following it religiously, let's say, adapt it to your personal needs, and then you will see how profitability in trading, out of what profitability in trading results, let's say. But let's come back here to the smoothing of the equity curve first. So let's say we look at the 1 hour chart here. Okay, this is 1 hour. I haven't shown it here, but we look at a 50-minute chart. This is our let's say the entry chart, where we enter our order based on our range, based on our identified advantage. And then we have here higher highs and higher lows, for example. And so what we can do is a very rough concept, even though, in my opinion, a very effective one. We have chance to say, okay, all what's happening here within this area, especially after identifying the structure of higher highs and higher lows, when the market starts to move here lower and give back some of the gains which it accumulated here during this progression. So if the market does this, this is usually the way where we talk about the accumulation area, and usually the area in which especially big traders, institutionals, start to build their position. Why do they do that? Because usually in the region of former highs, a region where everyone is expecting a breakout to happen, where someone is placing the stop, where someone is somehow sure that the market will keep on trending here, it's an area of high interest for many market participants. And this is usually not the area an institutional guy who really has to buy large chunks of whatever stock or index or a fixed currency pair or a bonds or whatever. This is usually not the area we want to buy or we want to focus on here, because we know other guys are looking there too. So you start to compete, even if you have great access to the market, very quick order execution compared to us retail traders. You can work directly with brokers, probably use dark pools, whatever. It doesn't really matter. But still, you have to compete with all these guys, and this is something you want to avoid. And the reason these guys start to accumulate here is because of the natural tendency of market participants focusing on such areas here, higher highs or lows, whatever, looking at these levels which were marked from the market before, let's say, where the market reacted in one or the other way, while this area here, market participants are still very skeptical, especially retail traders. Or won't we move lower from here or something like that? It's not that those institutional guys know that we will break higher. Probably they have an idea due to their information flow, whatever. But still, they try to anticipate these breaks, and the uncertainty they have here. And while they do not know whether we will break out and continue with the trend, if this is the thing, they get a better price here, usually. So if we trade here, anticipate such a break, the risk reward is better. And this is what they get in what they get on the other hand for this uncertainty in this case. So, and this is usually where you want to position yourself in an aggressive way. So if the breakout here on our 50-minute time frame is happening on the upside, with us having identified the open range, and then the breakout occurs on the upside while we trade above the EMA 10 on a 50-minute time frame, and you identify that on an hourly chart, you are here within this accumulation area, usually you say, okay, I'm also buying aggressively within this region here because I have potentially big money behind me supporting this move or making the market move in the direction of my breakout here. While if you break out here and the market has run already some meters, let's say, on the upside, usually the risk reward is getting unattractive, and usually you get those institutional guys here selling their equities, whatever, and usually you can't really expect them to support your position in direction of the trend. And this is usually then something where you say, okay, I'm more conservatively with my position. Okay, that's it, how to smooth the equity curve. Just a basic concept, even though an interesting one. Let me just now show you here. Oh, by the way, let's do it that way. Okay, so now you wonder probably how to profit from this knowledge. And this is probably something which is very, very important and is coming down to what I already said. You have to really bring this knowledge or especially the strategy to the level of unconscious competence here, which means nothing more than you use this strategy and the knowledge as a profitable fundament, knowing after seeing especially the backtest result, okay, it works, obviously. And then you fine-tune it with your personal preferences. And then you start on trading it over and over and over and over again to get to know a trading routine and grow. You can go through every day. You can journal your trading, and then you can try to improve your trading thanks to real results based on the strategy. You know, okay, the hit rate has been this and that over the last 4 weeks. The average gain was this and that. The average loss was this and that. So that was what my result is. What was the result of the basic strategy? So probably you intervened for whatever reason. You didn't really trade through it, but you said, okay, now I think probably I intervene from a discretionary perspective to smoothen the equity curve. If you get a better result, try to write down why it was better. If you get a worse result, write down why it was worse. And now you have a cycle you can follow. So you start out with, let's say, downloading a demo from the website from Admiral Markets. You make the first 20 trades in a demo environment. You record the results in your trading journal. Next, you calculate things like hit rate or loss rate of these 20 trades, the payoff ratio, so average gain to average loser, for example. And then you look at the result of the basic strategy. If you performed the same way, if you fully automated it, great. If you intervened, you were better. Why were you better? Respectively, if you weren't, why weren't you better? Or why were you worse than the basic strategy? You filter out the area causing underperformance, also overperformance. But let's first focus on underperformance, and then you improve. You wonder, you answer the question, how can I get rid of these identified mistakes? And then I implement the change. I repeat. I start from 20 trades again with the suggested setup and take it from there. And running this over and over again, repeating this cycle over and over and over again, will then bring this knowledge and this procedure to the state of unconscious competence. One day, it's just like I wait for the market to open at 3:30. I wait for the first 45 minutes. I have the high and the low. I identify the advantage. I say I'm above the EMA 10 on a 50-minute time frame trade on the upside. Take it. Then take out the trade, and that's it. And you do this over and over again, and one day it's like, yeah, for example, driving a car. It's the same concept here. It's unconsciously competent, which makes it possible for you to drive the car to, let's say, I don't know, let's say to the hospital because your wife is pregnant, and you can call all the family and tell the family, I'll be a father in a few hours, and I just want to. I'm so excited. And then on the back seat you have your firstborn son, and you have to tell him, hey, please be quiet. Mama needs some rest and needs some calm music playing around, and then you take care of the bicycle, which is going straight while you have to go around the corner, and you all do this unconsciously. You can drive the car without really thinking about it. The same is true for trading. Yes, so that's it on this. So the conclusion is open range are predefined time periods and thus occur in near all markets. We already said this. Open range can be profitably traded in high liquid markets, especially equity indices, FX, bonds, also blue chips like Google, Microsoft, all this. You find out your preferred asset here, and then you can start defining such ranges and work out a strategy which works for you. Also here, using filters when trading the open range breakout can be a very effective way of reducing fake out potential and increase the overall hit rate, respectively profitability of the ORB. For example, we set this a min range width, for example, or we use moving average. And this is the next most important thing, probably. We have a clear rule-based trading approach. The ORB can easily be automated, help to minimize the influence of emotions in your trading. By the way, emotions, this is a topic of next week's webinar, Wednesday. We'll look at the behavioral finance still, or nevertheless. On Monday, at the same time, Paul Wallace will talk to you about the 3-bar reversal. If you, right now here, within this webinar, you get a reminder, and you don't need to register if you watch the recording. Thanks for your like, by the way. Then you will have to register. You find the registration here below this video, and the answers, which will be questions by the questions which will be answered by Paul, are, for example, what is the 3-bar reversal? Where and how do they set up? How can we use them in forex markets? again. 1 p.m. I'm sorry, I think it's 12 p.m. GMT. I think it's 12 GMT. I'm not sure. I think it's 2 hours right now from Central European time, but it's 2 p.m. German. That's what I can say. And 1 p.m. London. Monday, August 26th. And yeah, check your inbox for the webinar link, or you watch it on YouTube, watch it here, click on the link. And in fact, for more, visit the website, admiralmarkets.com. And thanks for your time. Have a good one. Happy trading, watch your stops, and I look forward to next week, Wednesday, with the topic behavioral finance. I really look forward to it. It's one of my favorite topics, and yeah, I hope you join me there. So have a nice weekend. Talk to you. See you. Bye-bye.